Hey there, my name is Daniel Zabala, and today I'm going to talk about some basic financial terminology and jargon that we throw around the world of finance. So whether you're talking about trading or investing for long term, there are certain words that get thrown around that can be very confusing if you don't really understand it or don't have context around the conversation. I remember when I was going through my master's program in finance at the University of Kentucky, in the very beginning it was very confusing because you're learning about all these different concepts and throwing the specific words around that can have different meanings depending on the context. For example, if I'm getting long the market, maybe I'm purchasing an ETF that follows the S&P 500. If I'm getting long the market, then I'm purchasing that with hopes that it's going to go up in price. If I'm getting short the market, it's the opposite. I would be selling something, in this case, that index fund or that ETF, in hopes that the market comes down in price. Okay. Now here's where it gets confusing. Say I want to short a put option. Well, in the previous example I just gave you, if I'm getting short the market or I'm shorting the market, both of those are interchangeable in that example. Shorting the market means you're hoping it's going to go down, or getting short the market, you hope it's going to go down. If I short a put option, that means I'm selling a put option, which actually means I think the market's going to go up. That's when it gets confusing. So in the world of options, you have 4 different basic ways you can approach options. You can buy or sell put options, and you can buy and sell call options. So if a stock price is here, let's use an arbitrary number of, let's say, $100 per share for company XYZ. If I was to sell a put option, I would sell that put option at $90. Okay, it's like an insurance policy. I'm selling that contract to someone else. So I'm hoping the stock price goes up or stays above 90. But on the other hand, I could sell a call option, which would be shorting a call option, hoping the price goes down. Let's say I short a 110 contract, hoping the price goes down or stays below 110. Either way, I could short a call option, I could short a put option, but both are opposites. So if I'm going long the market, I'm hoping the market's going to go up in price. If I'm going long a specific stock, I'm hoping it goes up in price. If I'm going short or getting short or shorting a specific stock or the market, I'm hoping it goes down in price. When we start to talk about options, it becomes more confusing. Like I said, there's puts and there's calls. Puts, you are talking about the price underneath the current stock price, so it's $100. Anything below that, calls, you're typically thinking about things above that price. But I can buy puts, I can sell puts, I can buy calls, I can sell calls. So really, again, the key takeaway from this, if you're talking about options, that's when it gets confusing. So just wanted to point out that one little nuance of minutia with this terminology of shorting or getting short and getting long, in hopes to build some clarity around terminology in finance. That's it for this video. Thank you guys for watching, and please like and subscribe and share, and there's much more to come.